The financial world is built on signals. You've got the ones everyone sees, the headlines, the inflation reports, the press conferences, and then there are the signals that really matter, the quiet ones, the actions that contradict the words, the moves made behind closed doors that show you what's really going on. The Federal Reserve is sending one of those signals right now. It's an emergency flare fired in the dead of night, and most people are missing it. While the talking heads on TV are still arguing about the last inflation print, the Fed is being forced to show its hand. They're quietly admitting they're terrified. They're admitting that their war on inflation is over, not because they won, but because they can't afford to keep fighting. They're getting ready to do the one thing they know how to do, the one thing that always follows a crisis. They are preparing to turn the money printers back on. And this isn't just a guess. The evidence is undeniable. And it's kicking off a chain of events that has historically led to the most explosive rallies in financial history. Gold, the age old canary in the fiat coal mine, is already screaming. It has begun a historic rally, shattering records and signaling a deep loss of faith in government printed money. But that's just the opening act. Gold's rally is the prequel, it's the trailer for the main event. Because history shows us with shocking clarity what comes next. In this video, we're going to break down the Fed's emergency signal piece by piece. We'll follow the money, connect the dots from past cycles, and look at the irrefutable data that proves why this signal is the ultimate confirmation that a crypto explosion isn't just possible, it's imminent. This is the story of how the Fed's desperation becomes the catalyst for the greatest wealth transfer of our generation. The Federal Reserve is in a corner. At their October meeting, they cut interest rates for the second consecutive time, bringing the federal funds rate down to 3.75 to 4.0%. Now, they've signaled the official end of quantitative tightening is coming on December 1st, 2025. These aren't minor policy tweaks. These are the sounds of a system under immense pressure. These are the actions of an institution that sees a crisis on the horizon and is reaching for the panic button. They're pivoting from a policy of restraint to a policy of rescue. And every single time they've done this in the past, it has marked a major market bottom and the beginning of a face-melting rally in risk assets. Gold is already reacting, but what this signal truly means for Bitcoin is a story that will define the next 18 months. The fuse has just been lit. To get the sheer size of what's happening, you have to understand the weapon the Fed's been using for the last few years. Quantitative tightening, or QT. Think of the economy as a giant engine. For over a decade since the 2008 financial crisis, the Fed was pumping fuel into that engine. That fuel is liquidity, or money. They did it through a process called quantitative easing, QE, printing trillions of dollars to buy government bonds, which flooded the financial system with cash. This pushed interest rates to zero, fired up borrowing and spending, and sent asset prices, stocks, real estate, and crypto into the stratosphere. But then we got the bill. All that fuel started a fire, inflation. The price of everything started to soar, so the Fed had to slam on the brakes by reversing the process. That reversal is quantitative tightening. Instead of pumping fuel in, they started sucking it out. Since the summer of 2022, the Fed has been shrinking its massive bond portfolio, effectively deleting dollars from the system. Its balance sheet shrank from a peak of nearly $9 trillion to just over $7 trillion, pulling almost $2 trillion of liquidity out of the market. At the same time, they jacked up interest rates at the fastest pace in decades, making it more expensive to borrow money. This was a deliberate, painful process meant to cool down the economy and kill inflation. The Fed's message was loud and clear. We are serious. We will be hawkish. We will hold rates higher for longer. We will keep our foot on the brake until inflation is dead. That was the public story. But behind the scenes, something started to crack. The system couldn't handle the pressure. The US government, buried under a mountain of debt, could no longer afford the high interest payments. The banking system, addicted to cheap money, began showing signs of serious stress. The money markets, the essential plumbing of the financial system, started to creak and groan, and that brings us to today. The Fed has just sent two of the biggest dovish signals in modern history, basically throwing in the towel on its hawkish fight. First, the big one. They announced the official end of quantitative tightening effective December 1st, 2025. Let's be clear. The program of systematically draining liquidity from the market is over. The great suction machine is being turned off. A Morgan Stanley report noted this move was about 6 months earlier than they had expected. While they say it isn't a full-blown restart of QE just yet, the main point is that the Fed is no longer actively removing liquidity. It's ending the relentless tightening that has defined the last few years second. And just as important, the Fed has now cut interest rates at its last 2 consecutive meetings. After a relentless series of hikes, they cut rates in September and then again at their October 29th meeting, cutting by another 25 basis points. Don't get it twisted. This isn't a victory lap. This is a pivot born of sheer necessity. An analyst note from Lazard Frères Gestion put it perfectly. Financial stability now takes precedence over fiscal rigor. The Fed is admitting that the system can't handle the current level of restriction. They're worried about breaking something. They're worried about the job market, the stability of the bond market, and the government's ability to finance itself. This is the emergency signal. When the world's most powerful central bank suddenly ditches its main stated policy, fighting inflation, to focus on preventing a financial accident, you have to pay attention. They are telling you through their actions that the risk of a systemic crisis is now greater than the risk of inflation. And in the entire history of modern central banking, their response to a systemic crisis has always been the same: open the floodgates of liquidity, turn the money printers back on. This pivot is the moment the clock starts ticking. It's the definitive signal that the financial environment is changing. The tide of liquidity, which has been going out for years, is about to turn, and the first asset to catch this new wave is always the same. Before Bitcoin, before digital assets, there was gold. For thousands of years, gold has been the ultimate barometer of financial distress. It's the world's oldest and most trusted safe haven asset. When investors, and more importantly, when central banks, lose faith in paper currencies, they turn to gold. Gold doesn't react to headlines. It reacts to deep structural shifts in the financial system. And right now, gold isn't just reacting, it's screaming a warning. The rally we have witnessed in 2025 is nothing short of historic. After years of being suppressed and trading sideways, gold has exploded higher. In October 2025, the price of gold smashed through the psychological barrier of $4,000 an ounce for the very first time, hitting a record high of $4,381 per ounce. As of mid-November, the price is hovering around $4,200 an ounce. This isn't just a bull market, it's a tectonic shift. It's the market's response to the Fed's emergency pivot and the terrifying fiscal reality that forced it. So what's driving this monumental repricing of gold? It's not just one thing, but a perfect storm of forces, all pointing to the same conclusion: a profound and accelerating loss of confidence in the fiat currency system. The first and most powerful driver is de-dollarization, led by the world's own central banks. The very institutions that manage the global financial system are now actively hedging against it. According to a 2024 survey by the World Gold Council, a record-breaking 81% of central bank reserve managers expect to continue increasing their gold holdings. This is the highest level of intent ever recorded. Their reason is simple. They are preparing for more political and economic uncertainty, and they see gold as the ultimate insurance policy. They are no longer just talking. They are buying at a historic pace. Countries like China, Russia, India, and Turkey are leading the charge, strategically diversifying their reserves away from the US dollar. This isn't a speculative trade, it's a geopolitical strategy. They are voting with their balance sheets, and their vote is for gold over paper. The second driver is a concept you're going to hear a lot more about: fiscal dominance. This is the root cause of the Fed's surrender. Fiscal dominance is when a government's debt and deficit spending are so massive that they start to dictate monetary policy. The central bank loses its independence because it's forced to keep interest rates low and print money simply so the government can afford to pay its bills. And the United States has absolutely entered an era of fiscal dominance. Let's look at the horrifying numbers. As of November 2025, the US national debt has surged past an incomprehensible $38 trillion. That's more than 125% of the country's entire annual economic output, GDP. The problem isn't just the debt itself, but the cost of servicing it. In fiscal year 2025, the federal government spent a staggering $970 billion on net interest payments alone. To put that in perspective, it's more than the entire national defense budget. It's the third largest line item in the federal budget, behind only Social Security and Medicare. It works out to roughly $7,300 in interest payments for every single household in America just for this year. This is the trap. The Fed cannot keep interest rates high because the US government would go bankrupt trying to pay the interest on its debt. The interest payments are projected to nearly double again by 2035 to reach $1.8 trillion per year. The Fed's pivot, ending QT and cutting rates, wasn't a choice. It was a forced move to stop the US Treasury from spiraling into a debt crisis. Sprott Asset Management described this perfectly in a November 2025 report, stating that major economies are increasingly operating under fiscal dominance, where large and persistent deficits shape monetary policy. This reality is forcing investors into what they call a broadening debasement trade. People are fleeing assets vulnerable to currency devaluation and rotating into hard assets like precious metals to preserve their purchasing power. This is what gold's rally is all about. It's a referendum on unsustainable debt and the inevitable money printing that has to follow. Gold is the first mover. It's the slow, giant asset that signals the direction of capital. It's telling us that the smart money, from central bankers to the world's most sophisticated hedge funds, is preparing for an era of unprecedented money printing. They understand the Fed is trapped. The debt is too large. The only way out is to devalue the currency. First, they come for the gold, but the playbook of the last decade shows us with perfect clarity what they come for next. In markets, this time is different are the four most expensive words in the English language. Human behavior, especially when it comes to fear and greed, is remarkably consistent. The cycles of central bank policy and the market's reaction follow a predictable pattern, and the pattern unfolding right now is a near perfect echo of the last major market bottom and the explosion that followed. To see where we're going, we have to look back at 2019 and 2020. Just like today, the Fed had been on a campaign of quantitative tightening. They were shrinking their balance sheet and raising rates, trying to get back to normal after years of easy money. And just like today, the system started to crack. In September 2019, a critical part of the financial plumbing, the repo market, completely seized up, signaling a severe shortage of liquidity. The Fed, terrified of another 2008, pivoted on a dime. They stopped QT and started pumping liquidity back into the system. This was the initial signal. It marked the end of tightening and the beginning of a new easing cycle. Sound familiar? It's exactly what is happening right now. What happened next is the critical part of the playbook. First, gold started to move. Throughout late 2019 and into 2020, gold began a steady, powerful rally as investors saw the Fed's pivot and knew devaluation was coming. Then, in March 2020, the global pandemic hit, and the Fed went from easing to full-blown panic mode. They unleashed the largest monetary stimulus in human history, cutting rates to zero and printing trillions of dollars. The result was an explosion in asset prices. Gold was the first to benefit, soaring to a new all-time high in the summer of 2020. But the real story, the one that created life-changing wealth, was what happened next. Bitcoin, which had been quietly consolidating, absolutely ignited. From its low in March 2020 to its peak in late 2021, Bitcoin's price surged by more than 1,500%. It was a direct response to the same forces driving gold, a flight from a rapidly devaluing dollar into a provably scarce, hard asset. The digital gold narrative wasn't just a meme, it was proven in real time. The sequence was clear. The Fed is forced to pivot from tightening to easing because of stress in the system. 2019 repo crisis, 2025 fiscal dominance crisis. Liquidity starts to flow back into the market. Gold, the traditional safe haven, rallies first, sniffing out the coming currency debasement. Bitcoin, the modern digital safe haven with exponentially higher upside, follows gold's lead, but with way more force. This Bitcoin lags gold phenomenon is a powerful and recurring theme. Gold is the supertanker. It's slow to turn, but its direction is undeniable. Bitcoin is the speedboat, drafting behind it, ready to accelerate at a blistering pace once the path is clear. Gold's current rally above $4,000 is the supertanker turning. It is confirmation that the cycle has begun again. The environment today is arguably even more powerful than it was in 2020. Back then, the Fed was reacting to an external black swan event. Today, they are reacting to a structural internal crisis of their own making, fiscal dominance. The debt is now vastly larger. The interest payments are more crippling. This suggests that the coming wave of liquidity won't just be a temporary emergency fix. It will be a permanent feature of our financial world. Currency debasement isn't a cyclical risk anymore. It's a structural certainty. We are in the phase where gold has already broken out. The market is processing the Fed's emergency pivot. Capital is starting to seek a safe harbor from the coming storm of inflation and devaluation. It has found its first home in gold. The historical playbook tells us where it's going next, but this time there's a new game-changing variable A development so huge, it's like pouring gasoline on a fire that's already been lit. This time the institutions aren't just watching from the sidelines. This time the government itself has surrendered. For years, the biggest question hanging over Bitcoin was the threat of government opposition. The fear that the United States, to protect the dollar's dominance, would try to ban or cripple Bitcoin. That fear was the single biggest wall standing in the way of true mainstream institutional adoption. In 2025, that fear didn't just disappear, it was turned completely upside down. In a move that historians will study for decades, the United States government officially surrendered its hostile stance and embraced Bitcoin as a strategic national asset. On March 6, 2025, the President of the United States signed an executive order titled Establishment of the Strategic Bitcoin Reserve and United States Digital Asset Stockpile. This wasn't some vague memo to study crypto. This was concrete action with massive implications. The order established a formal strategic Bitcoin reserve, treating Bitcoin as a reserve asset on par with the nation's strategic petroleum reserve or its legendary gold holdings at Fort Knox. Let's break down what this landmark order actually does, because the details are what make this so incredibly bullish. First, the reserve is to be funded with the huge stashes of Bitcoin the US government already owns, coins seized in various criminal and civil cases over the years. Estimates put the US government's holdings at around 200,000 BTC, making it one of the largest single holders in the world. For years, the market has lived with the fear that the government would dump these coins on the market, creating massive selling pressure. The executive order destroyed that fear. It contains a stunningly direct and powerful clause. Government BTC deposited into the strategic Bitcoin reserve shall not be sold and shall be maintained as reserve assets of the United States. Read that again. The United States will not sell its Bitcoin. It is now officially a long-term holder, a hodler. The biggest potential source of government-induced sell pressure has been taken off the table permanently. Second, the order goes even further. It authorizes the Secretaries of the Treasury and Commerce to develop budget-neutral strategies for acquiring additional Bitcoin. While it doesn't authorize outright purchases with taxpayer money yet, it opens the door for the U.S. to strategically increase its holdings. A bill later introduced in the Senate, the Bitcoin Act, would direct the Treasury to purchase 1 million BTC over 5 years. The signal could not be clearer. The US government is not only holding its Bitcoin, but it is actively planning how to get more. Think about the sheer size of this paradigm shift. The government that prints the world's reserve currency is now officially stockpiling a competing non-sovereign store of value. Why would they do this? The answer is terrifyingly simple. They see the same writing on the wall that we do. They understand the math of their own debt. They know that fiscal dominance is real and that currency debasement is the only way out. Creating a strategic Bitcoin reserve is the ultimate hedge. It's the government hedging against its own monetary policy. This act provides an unprecedented layer of validation for Bitcoin. It tells every corporation, every pension fund, and every institutional investor in the world that Bitcoin is a legitimate strategic reserve asset. The career risk that once came with allocating to Bitcoin has been replaced by the career risk of not allocating to it. This isn't happening in a vacuum. It's happening at the exact moment the Fed is being forced to pivot back towards easy money. This is the 1-2 punch that changes everything. On one hand, the Fed is signaling its intent to devalue the dollar. On the other hand, the US government is signaling its intent to preserve its wealth in a scarce digital asset. They are simultaneously steering the fiat ship towards an iceberg while quietly loading up the Bitcoin lifeboats. The creation of the strategic Bitcoin reserve is the final piece of the puzzle. It removes the existential threat of government opposition and replaces it with the ultimate form of government endorsement. It provides the institutional green light just as the liquidity tsunami is about to be unleashed. We've now laid out all the pieces on the board. Let's step back and look at the whole picture, because the chain of events is logical, sequential, and leads to one inescapable conclusion. First, the foundation. The United States has entered a state of fiscal dominance. The national debt is so large and the interest payments so crippling that the government's needs now dictate the Fed's monetary policy. The Fed is no longer an independent actor. It's a captive of the Treasury. Second, the catalyst. This fiscal dominance has forced the Fed into an emergency pivot. Despite ongoing inflation, they've ended quantitative tightening and have started cutting interest rates. Their actions prove they are more afraid of a debt crisis than they are of a devaluing currency. This is the primary signal that a new era of easy money has begun. Third, the confirmation. Gold, the world's oldest indicator of currency debasement, has responded with a historic rally, soaring past $4,000 an ounce. Central banks and the world's smartest investors are fleeing from fiat currencies into the safety of hard money. This confirms the market gets what the Fed's pivot means. Fourth, the game changer. The United States government itself has validated the digital gold thesis in the most powerful way imaginable. By establishing a strategic Bitcoin reserve with a mandate not to sell, it has officially designated Bitcoin as a national strategic asset. This provides an unprecedented green light for institutional adoption, removing the final barrier of regulatory fear. And that brings us to the final act. All of these forces are converging to create the most bullish environment for Bitcoin in its entire history. The core value of Bitcoin has always been its absolute mathematical scarcity. There will only ever be 21 million Bitcoin. This stands in stark, brutal contrast to the US dollar, which can and will be printed in infinite quantities to paper over fiscal irresponsibility. In an era where currency debasement is a mathematical certainty, the demand for an asset with perfect scarcity becomes almost infinite. This time, the on-ramps are already built. The launch and success of spot Bitcoin ETFs in 2024 and 2025 created regulated, familiar, and easy ways for mainstream capital to flow into Bitcoin. While inflows have been volatile, with tens of billions of dollars already invested, this is just the beginning. Trillions of dollars in institutional capital, managed by firms that couldn't touch Bitcoin before, can now allocate with the click of a button. Now, connect these 2 points. We have a tidal wave of new liquidity about to be unleashed by the Fed, desperately seeking a home that protects it from the very inflation the Fed is creating. And for the first time, we have wide open, regulated, institutional grade pipelines leading directly into a provably scarce, government endorsed digital asset. This is a recipe for a demand shock unlike anything we have ever seen. The rally we saw in 2020 was driven by retail investors and a few brave institutions. The coming rally will be driven by the mainstreaming of Bitcoin as a core portfolio asset for everyone from global corporations to pension funds to everyday savers. The emergency signal from the Fed was the starting gun. The gold rally is the first lap. The establishment of the strategic Bitcoin reserve has cleared the track. What's coming is not just another bull market. It is a fundamental repricing of the world's only truly scarce asset against a backdrop of infinite money printing. The explosion is no longer a question of if, but when. And all the signals are telling us that the time is now. So let's put it all together. The Federal Reserve is trapped by a mountain of debt, and its only way out is to devalue our currency. Their recent actions, ending QT and cutting rates, are an emergency signal that the great debasement has begun. Gold heard that signal loud and clear, shattering records as the world's central banks run for the safety of hard assets. And in the most stunning plot twist of all, the US government itself has validated Bitcoin as a strategic reserve asset, a lifeboat to protect against the very storm it is creating. Every single piece is now in place. A wall of institutional money that just got access to Bitcoin through regulated ETFs is about to be met by a tsunami of freshly printed liquidity from the Fed. The narrative of digital gold is no longer a theory. It is now the stated policy of the most powerful nation on earth. These are not normal times. The signals moving the markets are deep, structural, and historic. Understanding the connection between the Fed's desperation, the government's strategy, and the mathematical scarcity of Bitcoin is the single most important key to navigating the financial world we are entering. The events of the next 12 to 18 months will not just define this cycle. They will likely redefine the role of digital assets in our global economy forever. The fuse has been lit and the countdown has begun. If you want to stay ahead of these market-moving signals and understand how global macroeconomics is driving the crypto markets, make sure you subscribe to the channel and hit the notification bell. You do not want to miss the updates that are coming. This story is just getting started.